All right, so I did a live stream about last week where we were actually reviewing other people's velocity banking videos, both teachers and critics and haters. And I came up with the top three list of misconceptions about the topic from what I've seen. And it seems like there's a good number of people in the online space who make videos about it and they don't understand it. I remember actually watched one video where it's like, I learned about this yesterday and I'm making a video about it, about why you shouldn't do it or something like that. And I was like, oh my goodness. Folks, that's the internet for you. All right. So now let's go over this top three misconceptions about the topic. So misconception number one of the videos I think I saw said like it requires home equity and that's why you shouldn't do it. And it's like, no, it doesn't. It requires a line of credit. You know, a personal line of credit and a home equity line of credit are pretty much the same thing, except with the home equity line of credit, you're putting your home as security, right? Your home is literally what you're putting as security in exchange for a really, really giant credit card like financial instrument, right? That's all it is, but the tool itself is the same. You might just get a lower interest rate and a bigger limit for providing that security. But I've heard people just emphasize it requires home equity or requires a home to do velocity banking, and they don't talk about the line of credit part, which probably means that they have no experience with any of the tools talked about in the strategy, right? Number two, it's kind of similar to number one. Number 2 is about like, you know, focusing on mortgage payoff. Like, this really struck sucks when it comes to just mortgage payoff. And I'm like, if you talk with actual people who are actually asking for help with the strategy, okay, this is kind of what you see. I mean, this might be an extreme case, but this person had 22 debts and $4.10 left over. And there was no home equity line of credit because we all know the rule with banks, they don't lend money to people who need it. So it's not like you can get a home equity line of credit here. And then here, right? So this is a personal line of credit that's maxed out. And we're not even thinking about paying a 30-year mortgage until we paid off all these other debts. Like, look at this, 22 debts, right? Yes, the mortgage is here. The mortgage is simply one debt out of 22. And so, in my opinion, this is my point of view. If you just have one debt and all it is a 30-year mortgage, this stuff doesn't really, it's not going to make a difference. But if you're in this situation, and that's why I say, we have to think of it as a general debt payoff strategy or a holistic debt payoff strategy. We have to think about the whole being, right? That's where the term holistic medicine comes from. The difference between, let's say, mainstream medicine, or I don't know if you ever heard of the term allopathic, versus holistic is that holistic looks at the whole body, whereas the mainstream medicine, they only focus on specializing, right? So that's why they have like the kidney specialists, even dentistry, right? They have a specialist with root canals. That's all they do, and they charge you up the wazoo, right? So we kind of have to think about the whole financial picture rather than just a 30-year mortgage. And this is where I kind of think that even the teachers of the topic go wrong, right? Because that's all they talk about. It's the way that I learned it, that it was marketed to me was learn to pay off your mortgage in 7 to 10 years. And if you ever seen our demonstrations, we always typically do it under 5. Probably. And if it's like under 7, it's like that's okay. But if it's actually like 7 to 10, that's actually kind of concerning, at least from our point of view in our demonstrations, right? And I say this as a person who paid off a mortgage in 2 years and 9 months. Okay. So, top three misconceptions about velocity banking. That one was number two, where everyone just focuses on the mortgage payoff. And this is just kind of something I see both from critics and teachers, where that's all they focus on. But if you ever like look at a real life case scenario like this one that I've dealt with, then you'll realize, oh, like, you know, think of holistically, think about general debt payoff, think about terms like segregation of income, what that means in terms of why people get into debt and why there's so many TikTok people who are struggling with debt and they're not just struggling with the 30-year mortgage, right? So let me just go back here. And then this one, number three, critics equate credit cards and personal line of credit. So I actually watched this video right here where this dude literally 2 years ago made a video and he actually said on the video, I learned about velocity banking yesterday. And then I'm going to make a video about it today. And it was clear that he didn't understand what the subject even was. So one of the things is like with velocity banking, they're asking you to put all of your money into a credit card, and you can't do that because you can't pay one credit card with it. And again, it's like, dude, credit card line of credit. I mean, in practical terms, they're not the same thing. I know a credit card is technically a form of a line of credit, but this guy clearly did not understand what it was even about. And he even said on this video, I just learned about it yesterday. And that's the internet for you. People talk about, what I've learned? People are experts on things that they've never done. I think this was a big shock to me. And I remember like a long time ago, Adam Carolla, he actually like had this book deal, and with like a New York City publisher. And then he was like, These people are so stupid because they would rather make $0 than rather get like 50% of something. And then like his whole revelation was, I had no idea adults were this stupid. You know what I mean? Now, I'm not saying that most adults are that stupid, but I remember that like him ranting about that like 10, 20 years ago or something. I had no idea that most adults were this stupid. But yes, number three, a credit card and a line of credit are not exactly the same. So dumping all your money into a credit card will bring some struggles. In fact, I got an email about this a couple of days ago. I said, hey, I can't get a line of credit. And I said, okay, well, I'm going to charge you some money if you want to talk to me because I just don't want to be bothered anymore. And I know how some of you are. It's like, don't you want to help people? Well, once you get to my wherever I am, my level, you have a lot of people who waste your time. You ever been a landlord? Okay, you ever been a landlord and then you try to put a house on the market for rent, and you know how frustrating it is when supposedly people need housing and then they don't even show up to their housing appointment. That's when you stop taking people seriously. If you have too many of those experiences, kind of leaves you a little bit jaded. Anyways, all right. So back to my point. Misconception number three: people think personal line of credit and credit cards are exactly the same, and the strategy is about dumping all of your money into a credit card, which is ridiculous. Like you can't. There's a reason why no most people don't overpay credit cards, just because of that friction that happens when you just try to overpay one, right? So that's why we're talking about doing a line of credit. All right, so let's go ahead and just do a very quick demo for today. I just always want to make every video under 20 minutes, and I actually have an average watch time of like 7 to 10 minutes. And I remember someone told me that if you just do Excel videos and you have an average watch time of like 10 minutes, that's actually pretty insane. So I got you all addicted to what I call the velocity method crack, right? It's an addictive experience where you just watch me do Excel videos and you're like, can debt payoff really be this easy? And, it's kind of like that Bruce Lee quote where I fear the man who does one kick 10,000 times. I just do the same thing over and over again. And this is why, like, I don't really take anything I do too seriously because, when you're really good at something, you don't really value it. I mean, think about you speaking your native language, right? Like how seriously do you take that? Kind of probably take it for granted because it's so easy to you. You see what I'm saying? This stuff is so easy to me. I'm just gonna actually speed run through this. And so, how do we pay off debt using what we used to call velocity banking till the state of Illinois went after the Kwok brothers and fined them $20,000 for using that term and trying to sell consulting services? Now we call it velocity method, but how do we start this? Well, step one is the budget because your budget is your debt attack plan. Okay, budget is your debt attack plan. Income, expenses, and look at that, leftover checking and savings, $90.26. And then in expense breakdown, we list every single debt that we have, and look at it, 5 debts, sucking up all of our cash flow. And then here we have our personal expenses not tied to debt. So the reason why this line item is different from the other ones is because this is the one thing that we still have to pay even if we're debt free, right? Or things, if you want to say, if you want to be more specific, right? So we just kind of lump into a category or same category of everything that's not tied to debt and just say, hey, this is probably our average spend just to live every single month, right? And so what we're going to do here is with our income and our expenses, right? The way that I first learned this is that it's a strategy where you change the flow of money and you don't have to change your income. And I think when you see it in a holistic light, that makes much more sense than saying that's about the 30-year mortgage. I think people who focus on the 30-year mortgage, I think maybe it's like a good angle or hook to kind of bring him in marketing, but I wouldn't do that because I feel like, in all honesty, that if you just do this with 30-year mortgage and that's your only debt, um, this may apply, but it's like you'll see the magic when it's about people with lots of debts and different debts, right? So let me go ahead and show you the cash flow index. If you don't know what the cash flow index is, basically a measure of ranking debt based on how much bang for your buck you get. So if you don't know the formula, it's really easy. It's just the balance of the debt divided by the monthly payment, and then what you do is you get this. Okay, and then you just kind of put the low ranking ones into what we call a line of credit. And so this high ranking one, we want to not pay off, or we want to pay off last. So why do we want to pay off last? Well, it's relatively easy because you're literally giving someone a lot of money for a little bit of cash flow, right? A lot of money, a little bit of cash flow. Whereas here, okay, this is like little bit of money, lots of cash flow, right? Like I pay these two credit cards, I'll get more cash flow than the mortgage. So it's all about bang for your buck, right? And so this is what we're going to do here. We're going to have an $80,000 credit limit. And we're going to assume we have a line of credit. So what's a line of credit? It's basically a financial tool where you could borrow money, put it back, and use it over and over again, right? So a credit card is technically a form of a line of credit, but in everyday language and everyday terms, it's actually not, because you can't dump all your money into a credit card, right? Like, you know this, look at this guy struggling to put the money in the credit card. I love the AI pick imagery. It's pretty good. And I always tell the AI, like, put it in a fun cartoony way. I like the fun cartoony way. It reminds me of the video game Fallout, even though, like, I've actually never played it. Okay. So let's go ahead and assume we have a free and clear line of credit at 8%. But here's the catch, and I'm going to quickly go over this. Banks don't lend money to people who need it. Banks don't lend money to people who need it. And so the reason why I demonstrate with the free and clear line of credit is, in all honesty, if you want to see a more realistic scenario, you're going to have a max. Most people who have lines of credit just treat it as a maxed out credit card, and we have to start from that. And I'm going to be here 1 hour and 30 minutes if I go over that scenario. So I just go over free and clear line of credit, and you'll get the importance of the line of credit. Now, let me just do this. Let's move these debts, these low cash flow index debts, which essentially is a high interest rate credit cards. And then that'll be 72,000, right? 72,000. And then we move it into the line of credit. Okay. Well, once we do that, guess what happens? Okay. This is like the craziest thing. Okay. These all go to zero. So these three credit cards all go to zero, and we literally turned $90. Okay. This is the part where it's like mind blowing. Same income. We literally turned $90 to 2,000 without making more money. Yeah, I know, right? Like, you're taking a look at that and you're thinking, what the F just happened? I know. Isn't that crazy? Isn't that, cr- I mean, is your mind blown like mine? I remember when I first realized this, I was like, this is the craziest thing on earth. And now I'm just used to it. It's kind of like you speaking your native language. It's easy. Everybody does it. And then you realize everybody doesn't do it. You know what I mean? Like, you're just looking at it like, oh, I just done this a million times. So, and I've posted over 700 videos on this on YouTube. Everybody should know this. And then sometimes I talk to fans, and you know what? They're at step 1.5. And I kind of overestimated how much people know because I post so many videos. But yeah, sometimes that's what happens. All right, so now let's go ahead and do the final step of you putting your entire paycheck into the line of credit, taking your expenses out, and then rinse and repeating over and over again. And that's kind of how we double down on paying off debt, is just putting your entire paycheck into it. So 2482.76. And then what we're going to do is we're going to take the average daily balance, multiply by the interest rate, and then you divide by 12. And then, well, blam, and let's go ahead and pay it off, okay? And then this is going to be 33 months, right? 33 months is completely wait, has it been 33 months? Oh, crap. What did I do here? How did I skip all that? I don't know. Okay, so now, okay, right. 33 months. And you see, I don't really take this too seriously either. So 33 months. And then 33 months and then 72K. All right, 72K. And then or do that for 3. And then we have the auto loan and the mortgage. And then we're just going to do this right here. And this is going to be 33 months. And then we see that in month 33, whoopsie, I didn't do it for both loans. Okay. We have the auto loan, the mortgage, and month 33, this is current balance. This is a cash flow index. But most people, I'm going to tell you where their eye is focused on. It's focused on this 4%. They're like, oh my goodness, this interest rate has the highest, or I'm sorry, this loan has the highest interest rate. I cannot believe it. Oh, my mind is blown. Why are we paying off the 3%? Well, the cash flow index is telling us to pay off the 3% first, okay? Because it's 10 grand, literally just 10 grand for $400, where here it's 223,000 for $1,100. So let's get the 400 immediately, pay this off, and then work on the 4% mortgage, right? So we get more bang for our buck in terms of cash flow, and then move it to the line of credit. And I'm going to go ahead and do this. And then this is going to be plus 10308.69. And then this is going to be 0 on the auto loan. And this is going to be 2,878.07. And then I'm just going to do this, copy and paste. Bam. Wham, alakazam, 2878.07. And then we see that in 36 months, look at that, the auto loan is paid off, right? So that's 30, was it 36 or 30? Yeah, I believe it was 36 months. So 36 months, and that would be 94K, I believe. All right. So now, what do we do here? Basically, we're going to pay off the 30-year mortgage. And so in how many months? 36 months, 235,000, 235,000. Hold on. Let me think about this for 1 second. 235,000. So let me go here. 36 months. Oh my goodness, someone's calling me. All right, sorry, I got distracted. So all right, so 36 months, 222,000. So now we can talk about the mortgage payment, right? And here's the thing, I've said this before, that if your mortgage is your only last loan, yeah, you can do extra payments. You don't have to use a line of credit, right? Now, here's one other thing I want to show you. Actually, give me 1 second. Sorry about this. Okay, so now I'm back. So back to what I was saying is that if the 30-year mortgage is your only debt left, yeah, you can do extra payments, right? But think about just a typical person. That is their default option. I mean, they don't have to get a home equity line of credit or any sort of line of credit to pay off debt. At that point, just throw all your extra money in. But if that's the default option that everybody knows, why don't people do it? See what I'm saying? Like people don't, people need alternatives because the current system doesn't work. And the reason why the current system doesn't work is because dumping all your money into a loan introduces friction and will possibly segregate your income. Now, if you don't know what income segregation is, let me refer to my original example, is that your money comes into your checking account and then it gets split all over the place, and then you leave the leftover in your checking or savings, right? That's essentially what income segregation is. So even though this is your only debt, you really, one of the reasons why you may want to use a line of credit is so that you just have a place to dump all your money in and you don't segregate your income. Now, I'm not saying that if this is your last debt, you'll get back to here again, but it's kind of like a seatbelt. right? It's kind of like for your safety. Well, that's the way that I think about it. All right, so let's go ahead, and this is what we can do is that we can move some of this loan into a line of credit, even if though it's like 8, 15, 30. Obviously, the higher the interest rate, the more you'll end up paying. But let me just kind of show you here. At This is a $6,000. So this is what we call sweeping, where we sweep a piece of the loan into the line of credit and then dump all of our money over and over again, right? Rather than to putting our money directly into the loan. Okay. So let's assume that we move $6,000 from the loan into the line of credit. You see that this gets paid off in 5.3 years, 25 grand. Now, if we double the interest rate, like let's say this is typical of a personal line of credit, I'm sorry, home equity line of credit interest rate at 8%, and then we do 15. Well, guess what happens? The interest that you pay double? No, it went up like 1 or 2 grand, right? So that's why, like, whoa, like I didn't know that. And then if you do 30, then it'll go up like 4 grand more, right? But here's the crazy thing is that if you move the entire loan into a line of credit right here, then you'll actually pay more interest than the 30% little sweeps that you do, because interest is not just about the interest rate, it's about time and volume, right? It's about time and volume. I like saying that because it makes me feel like the education that I learned in like early high school with like those chemistry and science equations, or time, volume, and energy equals MC squared, is something. It makes me feel smart, even though I pretend to be in real life. No, I'm just kidding. All right. So what was I talking about? Okay, so 25 grand at 8%. And yeah, so that's pretty much it for I think that's it for today. Those are top three misconceptions. We're at 22-minute mark. All right, so 5.3 years. Let me just go back here. And I'm just gonna do 36 divided by 12 plus 5.3. And then now, after 8.3 years, we are debt free. Debt free. Okay, well, if you made it to the end of this video, I just want to let you know that I'm running a test beta pilot program of debt advisory. So if you're interested, go ahead and click the Google form link below. Okay, I'm going to only open this for about 2 months, and this is going to be severely, not severely, actually severely the right word. It's going to be really discounted, because once I go live, it's going to cost probably over $5,000, right? So it's going to be high ticket service, but if you want to try it out, be my test beta client, go ahead and click the Google form link below. It's only going to cost $247, and you'll be able to get some of these spreadsheets in your own personal numbers. And so go ahead and do that, and then hopefully I'll hear from you soon if you're interested. Okay. All right. Well, have a great day, everybody, and I'll see you on the next video.